A lot of people think their biggest tax challenge is during their working years, but that's simply not true. Retirement comes with its own set of tax rules and its own set of tax strategies. Learning to navigate those rules is key to maximizing your after-tax income and long-term wealth in retirement. So in this video, I'm going to walk through 8 different strategies that you can use to minimize your taxes in retirement. So the first thing you need to understand is required minimum distributions, or RMDs. While these might feel like something far off in the future, the truth is sometimes the actions that bring us the least immediate gratification can lead to the biggest long-term benefits. Just like paying some tax today could mean big tax savings down the road. Depending on your age, RMDs are going to be required beginning at either 73 or 75. And if you have significant pre-tax retirement balances in IRAs or 401ks, those accounts have the potential to significantly grow before you get to that age. Now, conventional wisdom typically says not to touch those accounts until you have to. Spend your taxable money and leave the tax-deferred money alone is typically what people say. But that advice isn't always true. Here's why. If you never touch those pre-tax funds before RMD age, your account can keep growing. And when RMDs kick in, the IRS essentially says, okay, that money can't grow tax-deferred forever. You'll be forced to take distributions, and every dollar at that time is going to be taxed as ordinary income, which is typically your highest tax rate. So what can you do about it? You can start withdrawals or Roth conversions early. Let's say you're in the 22% tax bracket. You could take a calculated amount from your IRA each year, enough to stay within that bracket. Taking distributions now means paying today's rate, reduce future RMDs, and smooth out your lifetime tax liability. If you do this systematically year after year between retirement and RMD age, the overall tax savings by age 75 could be substantial. If you look at this analysis that we did for a client at Paces Ferry Wealth Advisors, you can see that the required minimum distribution significantly outpaces their need to reach their goals. So this orange line indicates what they need to do to hit their goals. And of course, it's going up over time because of inflation. But the required minimum distribution starting at age 75 is significantly more than they actually need when you add in their pension and their Social Security benefits. And if we look at this tax analysis for the same client, we could see the tax brackets are 12, 22, and 24% here. And you can see that they're paying well into the 22% bracket because of those required minimum distributions. And we saw in the last screen that they didn't need all of that money to live. So let's see what would happen if we were to take money out of the IRA early in order to mitigate the future tax liability. So if they were to do something called QCDs, or qualified distributions, which is where you take money out of your IRA before you actually need to because of required minimum distributions, their estimated tax savings is $124,000 over their lifetime. And you can see that the required minimum distributions don't push them as much into the 22% tax bracket. So if we look at this analysis for this client on a more granular basis, in a single year, if they didn't take an IRA withdrawal, their total tax liability would be $3,600, but they're still in the 12% tax bracket. So now if we were to look at their actual brackets and where they fall, they're only paying $14,000 in this 12% bracket. So remember, we talked about filling up that bracket before you go into that next level. Now, the way tax brackets work is that if you spill over into the next bracket, you're only going to pay a proportional amount of extra tax at that higher level. But in this case, going from 12 to 22 is a big jump, right? So what could they do in order to stay within the 12% tax bracket? So if they were to take a $50,000 distribution out of their IRA in this same year, this is what their tax situation would look like. So it would jump from $3,600 to $13,600. They're still in the 12% tax bracket. And as you can see here, they still have a little bit of more room to run in the 12% bracket. So total income so far for ordinary income tax purposes is $88,000, and they can go up to $96,000 before they jump into the 22% tax bracket. So it's important to take these things into consideration when you're planning your tax strategy and know the brackets that you're working with. What bracket are you in, and how much room do you have to run until you enter the next bracket? Now let's move on to Roth conversions, because a Roth conversion lets you move money from your pre-tax bucket to your after-tax bucket. So you're going to pay the taxes now, but the funds are then going to grow tax-free for the rest of your life. So there's a double benefit there. Depending on the way you look at it, it could be a double tax benefit. You pay the tax at a lower rate today and gain the ability to withdraw those funds tax-free later on. Let's say in future years, you need a $50,000 withdrawal for a new car. If that money's in a Roth, taking it out doesn't increase your taxable income or risk triggering IRMA surcharges, those additional Medicare premiums tied to income levels. In the eyes of the IRS, a withdrawal out of your Roth account is like a tree falling in the woods. It's almost like it never even happened. By doing systematic Roth conversions now, you're filling up your current bracket intentionally, not accidentally by spilling into the next one. So if we look at that same financial plan that we did before, this is what it looks like before any type of tax strategy is initiated, and their required minimum distributions is $179,000. Now, if we did Roth conversions up to that next bracket, here's what it would look like. And the RMDs went down significantly. So over $170,000 down to $111,000. And the tax savings also increase to $147,000. So the tax savings and benefit for the Roth conversions will typically be more than just a qualified distribution because that money will also grow tax-free and come out tax-free. Now, you can't do both equally because they both count toward your ordinary income. However, if you need some money to live, but not all of it, you could do some withdrawals and some Roth conversions, still staying within a certain tax bracket. So the next strategy that I want to talk to you about is something called qualified charitable distributions, or QCDs. And many of these strategies can be stacked on top of each other in order to come up with an optimal tax solution. But once you reach the age of 70 and a half, you can donate directly from your IRA. This counts toward your RMD once you reach the age of 73 or 75, depending on your date of birth and when your RMDs start. But the distribution isn't recognized as taxable income. If you give, say, $10,000 a year to charity, but don't itemize your deductions, you might not be getting any tax benefit at all. By making those gifts through a QCD, you effectively donate pre-tax money, lowering your future RMD and taxable income at the same time. Now let's talk about just optimizing your account withdrawals in general. Let's assume that you want to live off of $150,000 a year. That income could come from a mix of dividends and interest, IRA withdrawals, pensions, and possibly Roth funds. The key is deciding which account to draw from first and in what proportion. So this individual has $167,000 worth of total income, but then they also get a $31,000 deduction, right? Because they're married filing jointly. So their Social Security is $85,000, but only $72,000 of that is going to be taxed because there's certain taxable thresholds when it comes to Social Security that are important to understand. And if your provisional income is over a certain amount, 85% of your Social Security is going to be taxed. They also have long-term capital gains. So this is important to understand. Long-term capital gains start out at 0% up to $96,000 if you're married filing jointly. But your ordinary income goes against your long-term capital gains buckets. But long-term capital gains don't go against your ordinary income buckets. So that's important to remember. If you had no ordinary income at all, you could realize up to $96,000 worth of long-term capital gains and pay zero tax. And they also have a pension. And so all of those things bring them into the 12% tax bracket for ordinary income and the 15% tax bracket for long-term capital gains. Now, let's say they need an additional $50,000 to live. Well, right now, they're paying a total tax of $15,600. And if they pulled all of that money out of their IRA, then they're going to increase their ordinary income by $50,000 because every penny of a IRA withdrawal is considered ordinary income. So here you could see they've bumped themselves into the 22% tax bracket by $38,000. And these can be a little misleading because the deduction is taken off of your ordinary income, but also their IRMA bracket is going to increase. So they're going to bump into their next IRMA threshold. Before, they weren't paying any premium surcharges on their Medicare, but now they're going to pay an additional $74 here, an additional $13 here. So almost an additional $2,000 just in Medicare premium surcharges. And if we go back and look at the ordinary income, because they're paying an additional amount in the 22% bracket, $38,000 at an additional 10%. So you do the math, it's an additional $3,800. Whereas if they would have mitigated their brackets and paid more at the 12% bracket and then maybe took some out of Roth and maybe some out of capital gains, then they could have saved a lot more money in their taxes. So let's see what would happen if they mixed and matched it. What if they took some money out of their IRA, some money out of their Roth, and some money out of capital gains by selling appreciated securities? So if they were to do that, instead of $27,000, which their tax liability was if they were to take it all out of their IRA, it's $20,000. They're going into the 22% marginal tax bracket. Here you can see they're only paying 22% for $3,800. They're going to have a little bit more capital gains at the 15% tax rate, but then also they're not going into the Medicare Part B premium surcharges or income-related monthly adjustment amount. So these Medicare premium surcharges are like cliffs. Once you go $1 over, you're going to pay the whole premium. So it's important to take a look at it and mitigate your taxes so that you can try to stay under it. The point is, this isn't a set it and forget it kind of thing. It's about coordinating your withdrawals each year to minimize your taxes over your lifetime, not just this year. Now, you don't want to drain your Roth too early because once it's gone, every future dollar is going to come from other sources that could negatively impact your taxes. And you don't want to rely solely on your taxable account either, because that lets your pre-tax accounts, those IRAs and 401ks, grow, which could potentially increase your future RMDs. A balanced withdrawal strategy helps to smooth out your tax bill and extend the life of all your accounts. It's important to develop a financial plan early to help your future strategy. This is what we help our clients with at Pace's Fairy Wealth Advisors. And if you'd like to learn more about how we could help you, I'll include a link in the video description. Next up, let's talk about tax advantage medical savings account. So if you have access to a health savings account or HSA, this is one of the most powerful tax tools available. It's triple tax-free. Money goes in pre-tax, it grows tax-free, and it comes out tax-free for qualified medical expenses. You can only contribute to an HSA while you have a high deductible health plan. So some people avoid using HSAs because they worry about paying that higher deductible. But here's how they work. If you contribute and you spend it in the same year, you've at least paid your healthcare bills with pre-tax dollars. The reason this is different from a normal plan is that typically you cannot deduct, or in other words, use pre-tax money to pay medical expenses unless they exceed 7.5% of your adjusted gross income. And even then, you're only deducting the portion above that. But the real advantage with an HSA comes from investing it. Once your balance passes a certain threshold and you want to check your plan's threshold, many plans allow you to invest those funds. Over time, that money can grow into a significant reserve for healthcare costs in retirement, and withdrawals remain tax-free when you use them for qualified expenses. Now, the next strategy I want to talk to you about is harvesting gains and losses in your accounts. Capital gains are taxed very differently, as we saw before, from ordinary income, usually at 15%, and in some cases 0% if your income is below a certain threshold. Going back to that example that we looked at earlier, you can see you can sell a certain amount of capital gains. You can realize gains up to a certain amount and pay zero tax. But once you enter the 15% tax bracket, you're also only paying 15% on those gains. So it's something to keep in mind when you're looking at where to get money from. But in order to mitigate even capital gains taxes, one thing that you could do is harvesting losses and harvest those losses against your gains. So if you sell a stock that you bought for $1,000 and now it's worth $10,000, your $9,000 gain is taxed at those capital gains rates, not your higher income tax rate. Now, if you have positions showing losses, you can use those strategically. Selling a losing position can often offset gains elsewhere, reducing or eliminating your capital gains tax. And if your total losses exceed your gains, the leftover can be carried forward indefinitely until it's used up. But only $3,000 of it can be used against your income in that year. So just be careful with the 30-day wash sale rule, because if you buy back that same position, or what the IRS calls a substantially identical investment, within 30 days before or after that sale, that loss won't count. So one thing to consider here, if you sell a stock for a loss, but you want to maintain exposure to the market, you can go directly into a broad market index investment, or ETF, and that won't be considered a wash sale because, one, it's not substantially identical, and because you're selling a stock and you're buying a basket of stocks. Now let's talk about charitable giving, because many people give naturally, but from a tax perspective, how you give can make a big difference. If you're still in your working years and have a high income, consider front-loading future donations into what's called a donor-advised fund. For example, if you normally give $10,000 a year, you could contribute $100,000 at once, take a full deduction this year if your income is high enough, and then give from that account over time. So why does this matter? Because there's a higher standard deduction through 2028 for couples over the age of 65, and it could be as high as $45,000. So many people won't itemize. If you're not itemizing, your charitable gifts may not reduce your taxes at all. So here's a 3-pronged charitable plan that you might implement. Maybe you want to front load your gifts today in a donor advised fund. Use the special charitable deduction for non-itemizers available in 2026 that allows up to $2,000 of charity deducted even if you don't itemize. And then once you reach RMD age, make qualified charitable distributions directly from your IRA, giving pre-tax money, reducing your taxable income, and still meeting your RMDs. Now, the last tax strategy that I want to discuss with you is just to look ahead at the future tax law changes and think strategically. Building on our most recent example of the charitable giving, that elevated standard deduction, which could be more than $45,000 for couples over 65, is going away in 2028. So maybe you make big donor advised fund gifts today, take the standard deduction for a couple years, and then potentially switch back to itemizing your taxes when the hurdle isn't as high to clear. What you do today can have a huge impact on your tax picture tomorrow. My name is Zach Morris. I'm the founder of Paces Ferry Wealth Advisors and a certified financial planner. If you found this helpful and want more videos on tax and retirement strategy, go ahead and subscribe and keep an eye out for more videos in the future. Thanks for watching.